The top business stories live from the Sky News City studio. JP Morgan CEO Jamie Dimon tells Sky News the US has the right to protect itself over trade with China. UK-based computer business Raspberry Pi confirms it's planning to float on the London Stock Exchange. Burberry profits fall as the slowdown in global demand for luxury goods continues. Plus, Virtue Motors announces record sales. I'll be speaking to its chief executive. Good morning, this is Business Live with me, Ian King. Jamie Dimon, the CEO of banking giant JP Morgan Chase, has told Sky News the US has the right to protect itself over trade with China, but said it needs to work close with its allies in standing up to the country. It comes a day after President Biden decided to quadruple US tariffs on Chinese electric vehicles. Mr Dimon also said the UK economy was in safe hands regardless of the election result. Here's what he said about the possibility of a trade war with China.
We have competition with China. I think the American government is doing the right thing to fully engage. That doesn't mean the Chinese are going to like everything we do, just like we don't like everything they do. But it doesn't have to be war. It could be tough competition, and we should be prepared for that. Again, I think the most important thing here is that we do it together. I wish that America stayed in TPP. Trade is a good thing. There are some downsides to trade, but we focus too much on that. And so, to me, we should count our blessings, be strategic, be very thoughtful, fully engage with China. They're not an enemy, but they're competing. They want a different world than we want. And I think they want a different world than we want in the Western world, the free and democratic Western world. So it's worth fighting for.
Jamie Dimon was speaking to Wilfred Frost, who joins me now. Wilf, Jamie Dimon got into a bit of hot water a few years ago with some comments on China. I thought he was a little more guarded this morning.
Yeah, I thought it was really interesting, obviously, in light, as you said, of President Biden announcing just yesterday of the quadrupling of tariffs on Chinese electric vehicles coming into the US. On that very short-term question as to whether that would lead to tensions with China and the US escalating again, he did say that will ramp it up again a little bit. And whilst China continues to support Russia, we're going to have a hard time, is what he had to say. As you mentioned, he also talked about the importance of economic allies sticking together in order to navigate not just China, but Russia, Iran and North Korea too. And that came up when I asked him about whether there was an element of US protectionism towards its allies in light of the Inflation Reduction Act, the signature piece of economic legislation, of course, that the Biden administration passed in 2022. And he said with regards to that, it should have been done with our allies. We don't want our allies to say America is going its own way. We don't want them to say America only. And there was a little bit of that, he said, within the IRA. In terms of US economic outperformance, Ian, particularly over the long term, he cited one aspect of that being down to the size of the US market and the economies of scale that come from it. And in light of that, he said the EU is one of the great accomplishments of mankind. That a quote that certainly stood out. Also, just touching in on the UK, you mentioned this a little bit coming into it. It's been a pessimistic tone, of course, over the last couple of years. He said, quote, I'm quite optimistic about the UK. He said, quote, I have enormous respect for Rishi. I met Keir for the first time yesterday. And one of the things I like is that they're pro-business. He said everyone he's meeting from the Conservative and Labour governments is talking about growing the economy. I asked him if he felt, therefore, that the economy here was in safe hands, whichever way the election goes. And he said, yes, I certainly hope so, and he'll help whoever wins, which I also thought was quite an interesting comment to come out of the man who, of course, is essentially Mr. Wall Street in the US.
All right, thanks, Wilf. Now, the British-based computer business Raspberry Pi confirmed this morning it's planning to float on the London Stock Exchange. The Cambridge-based company, best known for selling low-cost credit card-sized computers that help children learn to code, is expected to be valued at around £500 million. Raspberry Pi, which was founded in 2012, has sold more than 60 million single-board computers and compute modules, including 7.4 million last year alone. It said sales last year came in at $266 million, while operating profits were $37.5 million. Well, some other stories for you now on a very busy day for company results. And the slowdown in global demand for luxury goods meant Burberry saw its operating profits for the year to the end of March fall by 34% to £418 million. Well, most of the damage was done in the Americas, where sales were off 12% on the previous year, although the company noted that sales were down by 17% in the Asia-Pacific region during the 3 months to the end of March. Burberry also warned of a challenging time ahead, at least for the next 6 months, forecasting that its wholesale revenues would fall by a quarter during the first half of the new financial year. Well, here's the current share price, off 3.75%. I can tell you that has also sent shares of luxury goods stocks across Europe lower this morning. Compass said today that full-year profits would be better than expected as it continues to win new business. The world's biggest contract caterer, whose customers include Google, Shell and the All England Tennis Club, said profits were now expected to grow by around 15% this year, up from the previous 13%. Well, Compass was reporting underlying operating profits of $1.5 billion for the 6 months to the end of March, up 18.7% on the same period last year, as higher pricing and new business wins helped offset higher costs. Here's the Compass share price, currently off just under 3% right now. Imperial Brands admitted this morning that stronger sales of its vaping and heated tobacco products has not been enough to offset the continued drop in demand for cigarettes. Bristol-based Imps, whose brands include John Player Special, Embassy, Lambert & Butler and the vaping brand Blue, said that during the 6 months to the end of March, tobacco volumes were down 6.3% on the same period last year. But adjusted operating profits rose by 2.8% to £1.67 billion as Bristol-based Imps made up for lower volumes by raising prices. Here's the share price, currently up nearly 4.5%. And the Canadian media group Thomson Reuters has sold its remaining stake in the London Stock Exchange Group. The Toronto-based news and information provider was part of a consortium which emerged with a stake in the business after LSEG paid it $27 billion 3 years ago for the data and analytics giant Refinitiv. The consortium, which also included the US private equity giant Blackstone, the Singaporean sovereign wealth fund GIC and the Canada Pension Board Plan Investment Board, sold £1.6 billion worth of shares in LSEG. They sold, though, at a premium to LSEG's closing price last night, and that sent the shares up 1.25%. Soaring demand from both consumers and credit providers has helped the global data and technology provider Experian to record results. Pre-tax profits for the year to the end of March came in at $1.6 billion, up 32% on the same period a year earlier, as Experian took its consumer services business to more than 180 million free members during the year. Brian Casson, the chief executive, said sales were up in all parts of the business, but grew most strongly in Latin America. Here's the Experian share price, currently up 7.5%. Now, acquisitions and strong demand from fleet buyers have helped the motor dealer Virtue Motors to record sales. The company, whose brands include Bristol Street Motors and Macklin Motors, today reported sales of £4.7 billion for the year to the end of February. That was up 18% on the previous 12 months. Pre-tax profits rose by 6% to £34.6 million. And joining me now is Robert Forrester. He's the chief executive of Virtue Motors. Robert, good to see you this morning. You make the point in the statement that used car sales prices were falling in the latter half of last year. What's been happening since then?
Well, I'm pleased to tell you that by March they'd stabilised quite nicely, and in our period post the year end, March and April, we actually saw margins increase on used cars. So we're back to more normal seasonalised levels, though there is a weakness in battery electric vehicles still.
Well, we'll get onto that in a moment. I just want to ask you about the composition of sales growth. It looks like most of it's come from fleet rather than from individual consumers.
No, that's right, and that's a key feature of the new car market at the moment. Fleet is selling the vast majority of the sales. The new car market in March and April actually has been down 10.8% for retail customers. We've got a very large fleet business, so we benefit from that, but you're right in exactly what you say.
Now, you make the point that battery electric vehicle sales have stalled. Obviously, the government is threatening fines on manufacturers if a proportion of their sales isn't above a certain level for battery electric vehicles this year. What is that doing to the market?
Well, the market is split into two for new battery electric vehicles. The fleet market is very strong. Company car drivers have very low tax on battery electric vehicles, so they're really demanding them. But the private consumer, the battery electric vehicle mix is less than 10% of private consumer sales of new vehicles. What this is potentially going to do is that I don't think the manufacturers will want to pay the fines. The fines are £15,000 for every car above the target. And the target's this year 22%. The market's currently at about 15.7. And then every year it rises to 80% battery electric vehicle sales by 2030. And there's a real supply and demand imbalance currently in the UK with this. The government are forcing electric vehicles through. The manufacturers are probably losing money on selling them and can't really do much more. And then they're looking at fines. So I think what we might see is supply of petrol and diesel new cars actually coming down. If not this year, then I suspect next year, which means consumers will have less choice, and the manufacturers will effectively hit the target, but actually on a lower volume, which has a number of implications for car production and the general automotive sector.
Yeah, I mean, Ford have already said they may have to restrict sales of petrol and diesel vehicles. Are you hearing that from other manufacturers?
Well, Stellantis, who supply Peugeot, Citroën, Vauxhall, have said very similar actually in recent weeks, and they're just the people going public. I think the logic of the situation is the government don't look like they're moving. It's an unreasonable situation, I think, for the manufacturers to find themselves in. So the logical thing is to curtail the market. So we might actually go back to a constrained new car market, and then that has implications for used cars and used car prices.
Absolutely. What do you think has caused battery electric vehicle sales to stall?
Fundamentally, there are no incentives for private consumers to buy battery electric vehicles. There are early adopters, and I've actually got one myself. But actually, for private consumers, the cost of them tends to be higher. They're concerned about range. The infrastructure is getting better, but it's still not to where it is for mass adoption. And the government is just not joined up at all. It just has not got a strategy to sort out power distribution, EV charging, and then it's got these fines to force the manufacturers without the consumers actually making a choice. And Rishi Sunak said he would let the consumers make the choice. That's why he moved the ban from 2030 to 2035. But the legislation that's come through after that just completely ignored what he said.
Now, separately in the sector, Robert, it looks very likely that Kazoo is about to go into administration. Would you be interested in buying any parts of that business from the administrators?
I don't think so. We actually picked up one of their sites last summer. We took their Tamworth site. That's now a Bristol Street Motors outlet in Tamworth. I think there will be people who are interested, but it's interesting that 2 years ago, this interview would have been about the dominance of online retailing, and today it's talking about its demise.
Yes, how quickly life moves on, Robert, doesn't it? Great to see you this morning. Thanks very much indeed.
Thank you.
Well, last night's gains on Wall Street, during which the Nasdaq hit another record high, were followed by another mixed session for stocks in the Asia-Pacific region. As you can see, the Nikkei hanging on in there above 38,000. The Australian market also higher on gains for the mining sector. Well, in Europe, here's the current picture just now. All of the main indices in positive territory, apart from the CAC 40 in France. Talking points today include Hapag-Lloyd. The German freight shipping giant is off 2.25% after its quarterly results disappointed. Well, here in London, here's the FTSE 100 just now. That's another intraday high that the FTSE has hit this morning. As I say, it's a very busy day for company results. And I mentioned one of the leading gainers earlier on, Experian, currently 7.5% to the good. Vodafone, meanwhile, up by nearly 4.75%. It's continuing to pick up support after yesterday's results. Another blue chip update in the market this morning is Spirax Sarco Engineering. That's ahead by nearly 3.75% right now. Outside the FTSE, some very big moves indeed. The energy services company, Hunting, is ahead by nearly 22% right now. That's after it secured a major contract from the Kuwait oil company. Meanwhile, the geotechnical contractor Keller Group, we've had the CEO of that company on the programme in the past, that is ahead by nearly 17% on an upbeat trading statement. To the downside, the UK-listed Bank of Georgia is off nearly 17% on the ongoing turmoil in Tbilisi. Foreign exchange markets, well, the dollar hit a one-month low against the euro earlier today ahead of today's US consumer price inflation figures. Sterling currently up 1/6% against the greenback and 1/10% against the euro. Meanwhile, the oil price has rallied this morning despite the International Energy Agency cutting its forecast for global growth demand this morning. A barrel of Brent crude will currently set you back $82.40 a barrel, and that is more or less unchanged right now, in fact. But joining me this morning is Laura Foles. She's Equity Income Fund Manager at Janus Henderson. Laura, we've got to start with Burberry. I mean, more bad news from the luxury goods sector.
Yes, it doesn't seem like it's getting much better. As you mentioned earlier, some of the other luxury goods names have also had weak results. So the likes of Kering, which owns Gucci, that had difficult results a couple of weeks ago. So Burberry are far from alone in disappointing in terms of their figures. I think what people are really looking for is those Chinese sales to improve. They remain very tough. There are some pockets of strength, so things like Japan, the Japanese economy is doing better, wage growth is better. So there are pockets of strength, but overall, I would say the results are slightly disappointing.
I mean, Burberry has been at great pains today to stress that this is an industry-wide problem.
Yes.
Are there company-specific factors that you would delight on?
There have been changes at Burberry at the top. We've had a relatively new designer who I think people are waiting to see if there's momentum behind the new designs. I would say this isn't a Burberry-specific problem, this is luxury goods in general, but prices have gone up a long way over the last couple of years. And I think there might be an element, when I think about it, I think there's a questioning of have you maybe alienated some of your historic customers? Burberry used to be seen as more of a mid-range designer brand, and it's definitely elevated its prices. So I think the question mark in my mind is there potentially a structural problem there with the prices being what they are now?
Yeah, and they do seem to have this issue with wholesaling as well in particular.
Yeah, they've called out wholesaling sales being down quite materially in the current period. I think there's an element of if you're a luxury brand and really moving to become a higher price luxury brand, you have to control where your clothes, your trench coats in particular, are being sold and make sure that you're really controlling those wholesalers. I think that's why they're guiding that down.
Now, elsewhere today, we've heard from Marshalls, the building materials supplier. What did you think of what they had to say?
Marshalls, it makes paving stones. They call themselves building products, but I always say it's paving stones. And anything exposed to that type of area is really tough at the moment. It's exposed to house building volumes. The house builders have really pulled back with interest rates going up to the degree that they have. House building volumes are very weak. Consumers, so the other side of Marshalls is consumers, you and me spending on our patio. And at the moment, when we're just not doing that, it's something that you can easily kick down the road a couple of months. It's not something that you have to spend on right here, right now. And with consumer living pressures that we've seen, it's a tough end market out there for them.
Yeah, absolutely. Now, obviously, the big event in markets today is the US CPI figures. What are you expecting?
So what the market is expecting is a slight softening. So we've been seeing about 0.4% month on month in terms of US inflation, and people are thinking it will come in more like 0.3. I think we need to see that softening. And the reason I say that is that US economic data, having been very resilient, is showing signs of cracking at the edges. So if you look at things like the City Economic Surprise Index, the payrolls data that came out, some things like credit card losses, that there are just signs here and there that actually the momentum is slowing. So I think if inflation doesn't come down a bit, in the back of people's minds, people will start to think about stagflation. If you have an economy slowing, but you have inflation being quite stubborn, that's not a good outlook. People will want to see that inflation number coming down, and that then opens the door to rate cuts in the latter half of the year.
Yeah, it's probably a cruel question to ask you, but should the Fed have cut interest rates by now?
I think no. I think there's a different question when it comes to the Bank of England, and I think we're beginning to see that dialogue change in terms of there's increasingly a view that the Bank of England might go first. Because the UK economy, I've spoken there about some slight weakness in the US economy, but the UK economy is in a different position. We're not in technical recession now, but we were until very recently. And we're probably heading for near enough the target inflation level in the UK in the coming months, due to some quirks around the energy price cap and things. So I think there's a different question for the Bank of England, but increasingly the view seems to be that the MPC might go first and the Fed to follow.
OK, Laura, got to leave it there. Great to see you as ever. Thank you. Still to come here on Business Live. I'll be hearing from Workday as it plans to invest more than £550 million in the UK over the next 3 years. Stay with us.
They're actually designed as diabetes medications. That's what they first sort of started out as, improving the way the body releases insulin. and deals with sugar. And what this study has shown is that actually, despite any weight that you may lose, it is still reducing your risk of a heart attack, your risk of heart disease. And that's incredibly important because general practice, the NHS now spends a huge amount of time and money looking after people with these chronic illnesses and trying to reduce their risk of a very serious event like a heart attack. I'm worried that really we've almost gone too far in our society with a lack of exercise, with a very difficult food environment, with a difficult situation where deprivation seems to come with also this chronic ill health from the poor food environment and the lack of exercise. So we are in a situation where the horse has bolted, if you like. We all know that we have huge problems with obesity and type 2 diabetes in this country. And it's far harder for people than simply eating a bit less or moving a bit more. That's sort of very reductionist and isn't sort of great health messaging. So if there are other options, just like there were sort of 20, 30 years ago when we started using statins, it may be that NICE, the Health Regulatory Board, actually has to make a decision to give people these medications, not even as a last resort, but maybe before that. Well, interestingly, when NICE regulated these drugs within the last year, they actually said people could only have them for 2 years because of the sort of health cost analysis, and it wasn't actually sort of going to be worth it, if you like. And this data really changes things because what this shows is actually the benefits will last even longer than that, and this will be saving people money. Aside from anything else, having a heart attack, having heart disease or a stroke is very costly to a health service. So I think this is going to have to change things.
Welcome back. The financial management and human resources software provider Workday said today it will invest more than £550 million in its UK operations over the next 3 years. The $65 billion company, whose 10,000 customers worldwide include Lloyds Banking Group and the Department for Education, as well as Sky News actually, said this was 40% higher than its investment during the last 3 years. Well, with me now is Daniel Pell. He's Workday's Group Country Manager for the UK and Ireland. Daniel, welcome to you. Put this into the context of how much you're investing globally.
Yeah, sure. So this is a very exciting day for us. As you said, I'm the country manager for UK and Ireland. This is a big investment, 550 million over the next 3 years, which is a 40% increase over the previous 3 years. So as an organisation, we're looking forward, and this is a big statement of confidence in the UK economy for us and a big investment for us. Carl Eschenbach, our chief exec, if you recall, was sat in this seat about a year ago, and he talked about our international expansion. So the international markets present about 50% of our global opportunity, but only currently today 25% of our revenue. So this is a big statement about our international growth plans, and we're starting with the UK. And why are we doing it now? Well, we've had great success in this market. We started here in 2011. We have over 35% of the FTSE 100 using our technology. Great British brands like Diageo, like Centrica, like Rolls-Royce. We have some great public sector clients as well, like Crown Commercial Services, National Archives, Department for Education you mentioned, but also we're seeing a real growth in mid-market enterprises for us as well. So great brands like Crew Clothing and Coventry Building Society. So this is about growth for us. We're an international business and we want to grow in those markets. But also this is about the wider skills agenda for us as well. So we really think there is a skills gap here in the UK today. And I think it's up to government, education organisations, an industry like us to really lean in and support that skills agenda.
Okay, what's this going to mean for your UK headcount 3 years from now?
So the investment is multifaceted. So we're investing in our people, we're investing in our facilities. So we're opening up a great new customer experience centre in our London offices for our employees, for our partners, but also for our community. So we've made some investments recently in a couple of great foundations and charities that help with skills. One called Generation UK and one called Ada, which is a digital school in Pimlico. And this is about helping people from disadvantaged backgrounds, helping them get the right skills to enter the job market. Because there's a real gap, as you can imagine, between those that have tertiary education and those that don't. So this is going to be a great facility for everyone. So we're making that investment today. But I think what we really care about is how do we help all organisations do better with their people and their finances. And organisations that are going to be successful combine those two together, and that's what we're really focused on today.
Now, one thing that I find really interesting about Workday is that you have a venture capital arm, including here in the UK. What sort of businesses are you backing?
Yeah, so we've made some investments, as you say. So we have Workday Ventures. So we've already invested in Multiverse, EduMe and Beamery, and they're all focused on skills. So we invest in organisations that we think are going to complement what we're doing, but also help the wider skills agenda. So this comes back to that conversation about what are we doing broader than just growth, and those are great examples of investments in that space. Yes,
Ewan Blair from Multiverse is a regular guest on this programme. You've talked a lot about how AI is going to transform the workplace. Why do you think so many people are nervous about that or sceptical about it?
I think with any new technology, there's a natural nervousness. The good news is AI, from a Workday perspective, has been built into our platform for the last 10 years. So we have a lot of experience here. But we need, as technology companies, to build trust around this technology. And so, we've all used AI in our everyday lives, whether it's Netflix, whether it's Amazon, whether it's getting a mortgage, approval process, that's kind of predictive AI. That's been around for a while. But generative AI has caught our consciousness now with, with ChatGPT and so on and so forth. So I think we have to do a better job of building trust. And the great news for our clients is, HR and finance data is typically the most governed data in any organisation. So we can be confident that the results are accurate. But I think also you have to have a human involved in that process. So if you're generating job descriptions or if you're running expense, report anomalies, I think that's a fairly kind of well understood process. But if you're using AI for recruitment, for example, and it impacts people's lives, you've got to make sure there's a human involved in that process to ensure that it's transparent, that the data being used is accurate, and that the outcomes are correct.
Very briefly, do you think business leaders ought to be taking more of a lead in getting employees on board with AI?
I think there is a role they have to take around communication of what their companies are doing. There's a lot for us to understand. It's new. But as I said, if you get the data piece right, and you can combine that with trust and transparency, I think we're all going to see greater output for UK companies. OK,
Daniel, have to leave it there. Thanks for joining me today. Appreciate it. Just before we go, I think we've got some live pictures of the King and Queen leaving St Paul's Cathedral from the service of dedication for the Order of the British Empire. We'll leave you with those. That's it from me. I'm back at 4:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Prime Minister's Questions with Jane Secker and Beth Rigby. And right on cue, there is His Majesty the King. I'll see you later. Cheerio.